Hey guys, it's MJ, and in this video I want to finish up the liquidity videos that we've been doing and look at something a little bit more technical known as liquidity risk elasticity, okay, otherwise known as LRE. Okay, so what is the point of this? The whole point of this is that, like we saw in the previous video, liquidity risk is an internal risk as well as an external risk. And what we want to look at is how vulnerable we are to the external conditions, or how will our liquidity risk change when market conditions change. So what happens when there's a change in market conditions? And if you did subject CT1, you might start thinking about immunization, and that is correct because we'll see that is something that we're going to be looking at later in the day. Remember that liquidity is not testing to see if your assets are greater than your liabilities. Okay, that's known as another accounting test. What we're looking at with regards to liquidity is, are your outflows going to be greater than your cash on hand at any time? And that what makes it quite scary is this at any time. It's something where you have to also consider the duration. So assets versus liabilities, yes, it's great if your assets are more than your liabilities, but it can still be problematic if you have some early outflows in the beginning and your assets are only coming in at the end. Then it can cause a business to go into liquidation. So how do we get around this, or how do we analyze our liquidity risk? What we're going to do is we're going to take our assets. So let's say these are our assets over here, and we're going to split them into two groups. Okay, we're going to have the one group called the illiquid assets, and the other one's known as our liquid assets. So an illiquid asset could be maybe say private equity, it could be property, those type of assets, whereas a liquid asset could be cash, shares, and short-term bonds. Also, what we're going to be doing is we're going to be looking at our liabilities, and we're also going to be dividing them into two groups. And the one group we're going to be considering as our stable liabilities. So this is when we've made loans to people that have a maturation at a guaranteed time. And then there could also be, say, our volatile, oops, how am I spelling volatile? Our volatile liabilities, when the payout of it is maybe a little bit shorter, maybe a little bit more uncertain, say a banking deposit being able to withdraw it at any time. So what we do here is we want to just consider our liquid assets to our volatile liabilities. And we look at what the difference is. So if we had to look at this difference here is known as the liquidity gap. And what we're here referring to is our net liquid assets. The problem, though, is that this is all great and everything under certain market conditions. But what happens under a stressful situation, such as a world recession, which is still in the minds of everyone who's studying finance? What happens if we're in a recession or there's been some sort of change in the interest rates? What do we do? What we then need to do is test the elasticity of our assets. So what I'm going to do is just draw another little diagram for you guys. It's going to be quite similar to the one we drew in the first video. So let's have these as our little liabilities. Dum, dum, dum. And let's have this as our assets. Okay, so what we're going to be doing under this technique, or under this type of liquidity analysis, is we want to take the present value of our assets and our liabilities at the current cost of funding. So cost of funding. So we're going to be discounting, here's times 0. Remember, this is very much subject CT1, financial mathematics. We're going to be discounting all of our values, and we're going to be seeing what is the deal. Do our assets meet our liabilities at all the various times? Do we have enough cash on hand? But now what we're also going to be looking at is, what happens if there is a change in the interest rate? Change in the interest rate, how is that going to affect it? Because remember, if the interest rate goes up, this value here becomes worth less. So at a high interest rate, that value, when you bring it back over here, is going to be worth less than at the other interest rate, which was maybe a little bit higher. We know that discounting cash flows does reduce them with accordance of time. Like I said, this is CT1, very basic stuff here. And by increasing the interest rates, yes, you are going to be decreasing all future outflows, both positive and negative ones. However, the further away something is, the more it's going to decrease. So this one is going to decrease a little bit more, but a little bit less, and this one might not be that affected. So if your liabilities are very much short-term and your assets are very much long-term, you are in danger from a change in the interest rates. And one of the ways to get around that is by setting up your portfolio in such a way that you incorporate the techniques of immunization. Although remember, immunization has a lot of weaknesses, it has a lot of assumptions that are flawed, so you do need to be aware of those. But I mean, that is very much subject CT1, and I guess CA1 as well looks at immunization. But the fact of the matter is that if you do have a liquidity problem under a stressful situation, it might be smart to trade out this long-term asset over here for another short-term or a short-dated asset in order to deal with changes in interest rates. What I don't like about this technique, though, is that we're only really looking at changes in interest rates. We're not looking at, say, the operational risk or the reliance of where these cash flows are coming from. And so again, it is not a perfect situation or a perfect model to take account of liquidity risk. You do have to take a step back and look at it from a more holistic level if you want to accurately combat and protect yourself from liquidity risk. But I think we're done. We've gone through a lot of the main risks. There are countless more that you could get into more detail about, and it's very good having a list of risks to be aware of when you go into exam conditions. Maybe see which ones are outstanding for that particular question, which ones apply to the scenario, and then talk and try and comment on each one. The big things, though, is that risks are very difficult to be modeled mathematically. They do all lack data, and it is much better to manage risks from more of a judgmental or an art position than, say, a pure science one where you're just going to target the factors. So overall, you do want to have a holistic approach and realize that the majority of these risks are interlinked, and you do want to be aware of the correlations that they have with each other. Anyway, that's the end of risks. I think now we're going to be moving on to regulation, or I'll check out the syllabus to see what other videos will be popping up tomorrow. But like always, thanks guys so much for watching. Hit subscribe, leave your thoughts in the comment section below. Let's have a discussion around this material. Cheers.